I'm still watching data to see to what extent I might revise that, but the current data I think point towards this kind of more stagflationary type of environment because, you know, especially in the modern day when people think of recessions, we've been so accustomed to think of 2008 and then like 2020 COVID, like these like huge deflationary just collapses. Whereas you look to the prior one, let's say after the dot-com bubble, for example, that was a mild recession. And I think the one now, it's not the same as back then because a lot of things were in our favor back then. But essentially, when you go back to the thing, whereas we're running 8% of GDP deficits when unemployment is below 4%. We're running $2 trillion deficits before there's even a recession.
Lyn Alden, an experienced financial analyst, shares an intriguing perspective on the current economic climate. In this captivating video, he discusses the possibility of a stagflation type of environment, deviating from the traditional deflationary collapses we've grown accustomed to during recessions. With data still being analyzed, Lyn provides thought-provoking insights on the impact of massive deficits, low unemployment rates, and the potential widening of deficits in the face of a recession. He compares this economic situation to what is often observed in emerging markets, where nominal numbers can still rise despite sticky inflation caused by currency problems and large deficits. Lyn also delves into the contrasting dynamics of different sectors, with some experiencing catastrophic deflationary busts, while others receive stimulation. As the video progresses, he touches upon the challenges of addressing inflation and the likelihood of it resurfacing when the focus shifts to growth. The intriguing part is yet to come, as he discusses oil supply, drilling patterns, and future projections. Stay tuned until the end of the video for Lyn's captivating conclusion and insights into the future. Don't miss out on this thought-provoking analysis.
And if we get a recession, those will widen because tax revenue will stagnate. And so, you know, it's just you absolutely can have a recession when you're doing that, but it changes the scope of the recession. And one comparison is kind of to look at what happens in emerging markets during recessions, right? It's I mean, there's different types of them, but a lot of times what ends up happening is that nominal numbers still go up. It's just that you have kind of sticky inflation because usually their currency is not doing great. So usually, so for example, their stock market is often going up in local currency terms during a recession, but of course it's doing poorly in dollar terms or gold terms. Kind of a harder money comparison. But usually you have that environment where because their currency is having a problem, because they're running big deficits, it's just a very different type of recession, which is it's not really a better or worse, it's just different. And so, especially with labor shortages and a $2 trillion annualized deficit, I think any recession we'd see in this environment is likely to be somewhat different than the big deflationary bust that we're used to. Potentially another way of looking at that is you can certainly have segments that are having that kind of catastrophic deflationary bust. I mean, I don't think too many people are bullish about office real estate, for example. With interest rates have gone what they do, and with their occupancy rates what they are, there are certain parts of the economy that I wouldn't touch with a 10-foot pole. But on the other hand, that's offset by basically things that are getting stimulated, right? So we have like record numbers of air travelers right now, even as we have, a lot of things point to recession. So if you look at gross national income, it says recession. If you look at ISM Manufacturing Purchasing Managers Index, that says recession. So a lot of different indicators suggest either recession or near recession, basically like stall speed. On the other hand, you're pouring money into the travel sector and you're pouring money into all these other things, you kind of balance it out, or at least, on an aggregate level, you somewhat balance it out, or at least you soften the blow. Of course, that comes with the cost of inflation does not come down as quickly as people think. And I think the biggest problem, when I analyze the topic of inflation, it's not whether or not they can get it down in the near term. And if you cause a recession, you can get it down in the near term, most likely. And that's so far what we've been seeing, a reduction in economic activity, reduction in year-over-year CPI. My concern is that the next time they want to have a period of growth, so the next time they want to have rising PMIs, the next time they want to have rising year-over-year GDP levels and things like that, there's a very high chance that it's going to come with some degree of inflation again because the core problems are not actually being addressed. So the rates and things like that, they're not actually addressing the core problem, which is the combination of large fiscal deficits and then any sort of like supply side constraints we run into, let's say energy, for example. Yeah, so far China had a slower reopening than a number of people thought. Their economy is kind of coming out of their lockdowns pretty sluggishly, in part because their fiscal policy at the moment is kind of the opposite of ours. They're not running big deficits. They're trying to be somewhat more austere. They've got other, they have problems in the real estate sector. They're doing a little bit of loosening with their monetary policy, but they're not really resorting to fiscal yet. And so China's coming out of this pretty slow. Also, Europe's partially deindustrializing because they just don't have the energy infrastructure to grow their industrial base the way they used to. And so we have kind of this like decent supply demand mix for oil at the moment. There's pariah states that are still able to get their oil to market, so the supply side's been decent and demand's been kind of muted. It's not been collapsing, but it's not been booming either. Or more specifically, it's booming in some areas, it's kind of pulling back in others. I think the challenge is that when you look at it a little bit further, so most of the growth in oil we've seen over the past decade was from U.S. shale. And that is, it requires constant drilling. You get oil supply online quicker, but if you stop drilling, it starts declining a lot quicker as well. It's not like an offshore oil project where you're going to get this like long, reliable period of oil with a big upfront cost. It's more like this rapid thing onshore. And the problem is that in recent months, drilling has kind of rolled over. And production has not rolled over yet, but that comes with a lag. And of course, depending on how much drilling rolls over, production could kind of flatline for a period of time. It could actually dip somewhat. But I think the point is that supply side just does not look super healthy. So, in the run up to the global financial crisis, so the whole most of the 2000s decade, you had a commodity bull market, but we also had a lot of new supply come online. There's a lot of drilling and a lot of capex and things like that. Whereas in this kind of recent bull market, all the participants have faded it. So all the oil companies, that when oil was spiking to 120, they're like, no, we're going to be disciplined. We're going to, strengthen our balance sheets. We're going to return capital to shareholders. We're not just going to keep plowing it back into the ground. And so that's kind of starting to materialize now, which is we never really brought a lot of supply online. We also, the United States drew down a strategic petroleum reserve. That's actually another way we kind of were emerging market like. So what does an emerging market do when they have a problem with inflation? Well, one of the things they can do is sell some of their foreign exchange reserves and try to shore up their currency. The United States kind of treated its oil like that. We drew down, not FX reserves, but oil reserves to, kind of helps fix the supply demand balance what was happening and, support, that inflation reduction. The problem is that can't be repeated again, at least not at that magnitude. And so when you look around and say, well, now there's not really like another SPR about to flood the market. Shale is, the production's kind of how it was a few years ago. It's recovered somewhat, but again, you have drilling rolling over. And so I think when you look out a few years, the oil market does look pretty tight. Now, when you look at any sort of 6-month period, that's, I think, more of a demand question, right? So you have to ask questions like, is China going to do some fiscal policy, or are they going to kind of keep in this like stall speed that they're on? The United States, are we going to enter or be confirmed to be in an outright recession? Or are these like fiscal deficits going to kind of keep us at stall speed, for example?
As we reach the end of this captivating exploration into current economic events, I hope you've gained valuable insights into the ever-evolving financial landscape. Remember, staying informed about the latest economic developments is crucial in today's interconnected world. By understanding the forces shaping our economy, you can navigate the uncertainties and seize opportunities that arise. Whether it's market fluctuations, policy changes, or global trends, staying engaged with economic news allows you to make informed decisions that impact your financial well-being. Stay curious, stay informed, and don't forget to like, comment, and share this video.